The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Adam Welch here with Insurance Agency Marketing Services. Thank you so much for taking some time out of your Monday mornings to join us here. I do appreciate your time here this morning. Today we are going to be taking a look at uh, ways to conduct prudent policy reviews and to why you should be conducting annual reviews and more specifically life insurance policy reviews with your clients and how that can possibly lead to new sales for you. So I feel like we have a great presentation put together for you, and we will get to that here momentarily. Before we kick things off and get things going, just a couple of housekeeping items to mention here. As we go through the webinar, if you have any questions that may come up throughout the course of the presentation, please don't hesitate to type those in the question box on your control panel and send those over. Be glad to stop and get those questions answered as they come up. Additionally, we are going to have a couple of poll questions, and as always, your participation in those poll questions is always greatly appreciated. Helps us get some additional information out to you on some relevant topics that you may have some additional interest in. So just very simple yes or no questions to those poll questions. And again, your participation's certainly appreciated in those poll questions. Before I get going into the topic of today's webinar, which is taking a look at the policy review process and why you should be conducting policy reviews with your clients, I want to take a few moments just to go through some great incentives, services, and rewards that we have available here at IAMS. I want to make sure everyone's well aware of some of these great items here that we have available when you're working with us here at Insurance Agency Marketing Services. And the first of those is our Referred Producer Program. So just like you all out in the field, the highest compliment you can receive, the most qualified lead you can receive out there is a referral. I don't care how much you're paying for your lead program and pre-qualified leads. If you get a introduction from a current client, that is certainly going to be the most qualified lead out there. And the same holds true with us here at IAMS. So how this program works, if you know of anyone out in the field that is in the business, not currently working with us here at Insurance Agency Marketing Services, we want to encourage you to make that introduction and pass them along to us. We want to work with them as well. So how this works is once you pass along a referral to us and that referral contracts with any one of our carriers here at IAMS, we're going to cut you a check right off the bat for $50 just for sending them over and allowing us the opportunity to get them contracted with one or more of our carriers. Once that referral starts writing business, this is really a great opportunity to get some additional cash in your pocket based on that introduction. So just some rough numbers here. We will pay a 20%, a 20 basis point override on business written by your referral thereafter. Once they're contracted, you're going to get a $50 contracting bonus when that referral contracts with us. You're going to get $100 when that referral writes their first piece of business, and then that 20 basis point override on that referral's business thereafter. So you can see in that example, can definitely be a very lucrative opportunity for you. If you refer over 3 individuals to us, and all 3 of those producers are $1 million a year producers in life and annuity, that equates to another $6,000 cash in your pocket just for making that introduction and passing that referral along to us. So certainly a great opportunity to earn some additional cash. It's important to note that referral bonus is not coming off of your referrals commission. It's not coming off of your commission. It's coming directly out of our pocket to you, again, as a thank you for making that introduction. So please keep that in mind as you're out there and networking with perhaps some other advisors, agents in your area. If they're not working with us here at IAMS, we want to encourage you to make that introduction and pass them along. We also have some great new producer bonus builders here for you. So this is a program for all new advisors with us here at IAMS in the first 6 months of getting set up with us here at IAMS. So how this works is once you get contracted with any of our carriers, we're going to reward you based on the business you write with us in the first 6 months of getting contracted. So your first 180 days, there's 3 levels to choose from here. Once you cash in at one of these levels, that's the new producer bonus and it's done. But have some great opportunity here to get some additional perks. So starting at that $100,000 level, within your first 6 months, you write $100,000 in annuity, single premium life, life target. These levels are prorated for Life Target as well. But any combination of those, you hit that $100,000 level, you can qualify for one of those three items you see in the upper left-hand part of the screen. Either a $750 cash bonus, which is certainly the most popular option in that category, or we'll pay for a 2-year website subscription for you and get you your own personal website created, and it'll be up and running for 2 years, and that's on us at that $100,000 level, or the latest generation iPad. If you have more than $100,000 in business in your first 6 months and you can hit the $300,000 level, the rewards get a little bit better, of course. So this level, you can choose from a Social Security marketing program and a 3,000-piece mailing to get some additional leads, or that $750 cash bonus bumps up to a $1,500 Visa gift card. If you can hit that $500,000 level, you have more than 300 and can hit that $500,000 level, of course, the rewards get a little bit better from there. So we have a couple of great business building rewards in the form of seminar marketing and seminar systems with two of our top producers here at IAMS, Matt Gill and Dave Pemper. They've both developed very effective seminar marketing programs, and they will make that available for you. Matt Gill and Dave Pemper, as I've mentioned, they are top producing advisors with us here at IAMS, always qualify for all the trips and do a high level of business here. And they've built their business around seminar marketing. So you hit that $500,000 level, that you can choose a 5,000-piece mailing with the seminar coaching and seminar system from Matt Gill, or you can take a look at Dave Pemper's seminar system. Two different seminar approaches, again, both very effective. And that comes along with a 4,000-piece mailing to help fill that seminar and get some great coaching with either Dave or Matt there. Additionally, you can also choose to take a vacation, and we'll put you in touch with our Ritz-Carlton Travel Rewards team to customize your own getaway and get some good rest and relaxation if you hit that $500,000 level. So great new producer bonus, again, rewarding you for your business you write with us during your first 6 months of getting contracted with us here at IAMS. We pride ourselves on the support we provide our advisors. We know your job is not an easy one. It's very difficult being out there in the field as an independent agent. There's a lot that falls on your shoulders, and we want to be the resource here and be your back office to help shoulder some of that back office responsibility that falls on your shoulders. We want to help remove some of that so you can work smarter and not harder out there. We want you to be more efficient out there in the field. So we provide what we like to call from submission to commission support. That means everything on the pre-sale support side, running quotes, running illustrations, helping you with case design and product selection. All of that, we can work with you, help you build the case, get you ready to present the case, get all the forms out you need to write the case. Once that case is written, send it back into us. We have a talented team of new business case managers that will scrub your applications for you to ensure they're going to be in good order once they hit the carrier to cut down on processing time. We will order exam and labs for you. If you're writing a fully underwritten life insurance product, we can handle all of that out of our office. And our case managers will continually follow up on your business to keep pushing the carrier along and make sure that business gets issued as quickly as possible so we can get you paid quicker. So submission to commission support, a lot of resources available for you on the back office side here at IAMS, and we want to be your back office solution and provide that top level service for you. So again, you can be more efficient out there in the field. We do have a very talented creative marketing team here at IAMS Creative. They do some phenomenal work in the creative marketing side of things here. So everything from your print material to online solutions, we have solutions that are ready to go out. We have turnkey solutions that are professionally written brochures and flyers that are ready to go. We just need to pop your information in, customize them, and they're ready to be printed or emailed, however you choose to handle that. We have agency solutions, which consists of building a brand. So perhaps you need to build a brand, you don't have a logo, or you need to rebrand your business. We can assist you with that, help you build a logo, get all of that new information popped on stationery and your advertising pieces. And then again, we also do work on the digital marketing side as well. So everything from creating a website for you to helping you with email marketing and social media marketing, all of those items we can assist you with as well. So keep that in mind. If you're in need of any of these items, give Tasia or Josh, their team, a call. They'd be glad to visit with you about what we can do and customize a solution for you. Our website, www.imsinc.com, certainly a tremendous resource. If you've not yet visited our website and registered to log in to get access to all the great information, I certainly encourage you to do so. A lot of great information out there, from our term quoting engine to our forms engine, current industry links, all of our life, annuity, long-term care, all those product grids are all available on our website. And of course, it's available 24/7. So perhaps it's after hours, you're in a pinch, you need a form, you need an application. It's after hours. That's always available on our website at imsinc.com. So you can go ahead and log in there, download those forms, and you should be in good shape from there. Again, if you've not yet registered for our website, certainly encourage you to do so. That again is www.imsinc.com. Our retirement analyzer software, this is a really powerful piece of software that really goes a long way to just illustrating the power of your clients working with you and implementing your recommendations. So it really kind of puts meaning behind the illustrations that you're presenting your clients, be it annuity illustrations or life insurance illustrations. Marcus Solar in our office is the point person for Retirement Analyzer in this software program. He'd be glad to visit with you in a bit more detail about what all is entailed with the software and how we can make that available to you. Great program here that can help your clients in a step-by-step process answer those 6 questions you see at the bottom of the screen there. So if you'd have interest in learning more about the Retirement Analyzer and possibly implementing that in your business, please give us a call and ask to speak with Marcus Solar. He'd be glad to visit with you in a bit more detail about that program. IAMS Wealth Management, and this is going to bring us to our first poll of the day. Just very simply, would you care for more information about IAMS Wealth Management? But many of you may be aware, some of you may not be aware at this point, that we have launched our own registered investment advisor here at IAMS, and that is IAMS Wealth Management. Number of reasons we consider doing that, but certainly a great opportunity to expand your business and increase your production and increase your income. If you're currently Series 65 license and managing assets, we have a pretty seamless transition for you to move that business over to IAMS Wealth Management and really simplify your life. And we've designed IAMS Wealth Management to do just that, to stay within the core principles here at IAMS and helping you work smarter, not harder. The same holds true with IAMS Wealth. We've designed our wealth management platform, fee-based asset management platform, so that you can be as efficient as possible. We don't want to make your life harder. So everything from the back office, actual asset management and trades and compliance, all of that we can shoulder for you, so you can focus on the things that matter most to you, and that's going out and meeting with clients and prospects and building those relationships, making those sales and gathering those assets. We'll take care of everything else for you. If you're new to the business and or at least new to the fee-based asset management side and have some interest in adding that, there are a number of reasons to consider doing so. Among them is going to be increased revenue for you. So instead of working on the transactional side and earning commissions on your annuity and life insurance sales, you're going to get some recurring revenue based on the assets that you have under your management. You're going to earn fees based on those assets under your management, and that's going to be recurring revenue. You can build up a bit more of a predictable income stream. You're also going to see an increase in your fixed and index annuity business and life insurance business as well, and this is because clients are going to view you more as a holistic advisor. You're not only just their insurance and guaranteed income advisor, you're also their wealth advisor, and it's more concerns that you can assist your clients with. That's no longer, the wealth management aspect is no longer something that's going to roll down the street to the next advisor. So you can help your clients with more of their wealth management needs. It's going to go a long way in improving client retention and strengthening client relationships. Again, being more of a holistic advisor goes a long way to keeping those clients with you versus going down to the next advisor that's knocking on their door. So we've developed this, again, to be as advisor-friendly as possible, where you can focus on meeting with clients and prospects and building those relationships. You're not going to get bogged down with the day-to-day asset management and trading of the accounts and the compliance needs that come along with this, or compliance requirements rather, that come along with asset management. We can shoulder the vast majority of that for you. That's how we structured this RIA. So if you'd like more information, certainly encourage you to click yes on that poll question. We can get some additional information out to you about how to come on board with us and get going. So with that, I'm going to go ahead and close that poll down. Thank you for those of you that did respond to that. And this is actually going to bring us to our second poll of the day, and this is about our very popular all-expense-paid life and annuity academy. We have our first meeting of the year coming up in March, and this is certainly a great opportunity for you to join us for a couple of days at no cost to you. So we take care of your flights, hotels, meals, all of those travel expenses is on us. Just costs you a couple of days out of your time. And we know that that's expensive in and of itself. That's 2 days that you're not going to be out in the field meeting with clients and prospects and making sales. So we want to load you up with as much relevant information as possible. These meetings are unlike any training event you may have attended with other organizations. We really hone in on the sales and marketing aspect of the business. This isn't a product roadshow where we're just going to hear from reps at different insurance companies talk about their product and why you should sell them. We want to give you some tools to help you get in front of more people and help you increase your business. We're going to load you up with a ton of information. Our hope is that one or two of those items may stick with you, and you'll be able to bring them back to the office at the end of the training event, the end of the academy, to implement immediately and see a measurable increase in your life and annuity production. So some of the things we'll talk about, we bring out several of our top producing advisors and some other speakers, go over some different marketing ideas, sales concepts, and sales approaches. Matt Gill and Dave Pimper, I mentioned on our new producer bonus slide, they'll be out there talking about their seminar marketing system and what they've done to build their seminar system, build their business around that seminar system. Talk about some unique trust products and building a business around that as a door opener to advance wealth transfer strategies and advance life insurance strategies. So talking about more of your large life case marketing, like the business insurance concepts, everything from your key person to executive bonus and buy-sell arrangements, get you in front of some larger premium life insurance cases, go over some wealth transfer tools from single premium life and similar types of products and how you can incorporate that into your business very seamlessly and effectively to help boost your sales and income and provide your clients with a great alternative, wealth transfer alternative. And of course, we'll go over some different annuity sales topics and current trends and things of that nature. So a lot of information presented to you. Of course, there is going to be some product information, but the vast majority of these meetings are geared towards giving you some different sales and marketing ideas to help you increase your business. Again, it is all expense paid, so all of your travel expenses are taken care of by us. It just costs you a couple of days out of your time. So looks like a lot of you did respond to that poll. Leave that open for a couple seconds more. If you would like more information, I encourage you to click yes. It's certainly not a commitment to attend. It's just indicating to us that you'd like to be made aware of the next dates as those are scheduled and get some additional information and how to attend one of these meetings. So with that, I'm going to go ahead and close this down. Thank you very much for those of you that did respond. We will get some additional information out to you. All right, the final item I want to visit about here is our marketing summit. We are working on the 2019 meeting and getting details put together for that. This meeting in 2018 is coming up here at the end of the month, February 25th to the 28th. So we're taking qualifying advisors out to the gorgeous Boulders Resort and Spa in Scottsdale, Arizona. Our marketing summit meetings are tremendous meetings designed to reward you for a good years of hard work, provide some strong education, strong information, and some rest and relaxation at the same time. The Boulders Resort certainly has some tremendous golf and spa facilities and tennis facilities and tremendous restaurants on site there. So this meeting is currently closed, and as you can see, it's getting ready to kick off here in a couple weeks. At the end of the month, and again, we are working on the next meeting. We'll have details out hopefully fairly soon for the next meeting, so you can get geared up for that. So with that, I'm going to get into why we're here today, and I'm going to talk about the annual client review, and more specifically the life insurance policy review. So what we're going to talk about, starting off with why annual client reviews, why complete these annual client reviews. We'll touch on why policy management is needed, especially more so today than ever before. Of course, we'll walk through a policy review and some of the steps to complete a meaningful and improvement policy review with your client. Then go over policy remediation, which could lead to new opportunities and new sales for you. So starting off here, why annual client reviews? That if you've worked with us here at IAMS for any length of time and have visited with us on the, I know for sure on the life insurance side, in the life marketing department, we are big on doing annual reviews with your clients. It's just, flat out good customer service. We believe that staying in front of your clients at least on an annual basis and reviewing the strategies that you've put in place with them, it's good customer service. All these strategies need to be updated as life changes. So a very important part of the business. We are firm believers here at IAMS in the annual client review. Again, it's going to keep you in regular contact with your clients. Clients are going to view you as a trusted advisor. So instead of just making the sale and never speaking to that client again, that sale could certainly roll off the books with the next advisor that's knocking on their door. It's going to keep you in front of them, keep your name in front of them, and keep them viewing you as their trusted advisor. Gives you an opportunity to update on different life-changing events. So, as life progresses, there's going to be changes in insurance needs. It's going to be an opportunity to update their existing insurance. So, for younger folks, if they're just getting started in their careers, marriages are happening, children are entering the picture. Vast majority of or vast opportunity to update those life-changing events that certainly is going to result in changes in insurance needs. Gives you an opportunity to be the one that gets the sale for those new insurance needs that may pop up. It gives you the opportunity to review and manage in-force insurance, and that's what we're going to spend majority of our time here today, is how to review and manage that in-force policy that you sold, or perhaps they have on the books from another advisor in the past. And of course, anytime you're in front of your clients is an opportunity to ask for referrals. And we can't stress this enough. As you saw with that referred producer bonus, it's the most qualified lead out there. Don't be afraid to ask your clients for referrals. You're meeting with them on a consistent basis. You're helping them with their insurance needs, perhaps their wealth management needs. Let them know the best way to compensate you is to introduce them introduce you rather to others in their network. And I can't stress it enough. Don't be afraid to ask for referrals. More often than not, clients are going to be willing to, give you the name or two names to contact and reach out, and they'll gladly make a recommendation to make that introduction. So don't be afraid to ask for referrals, and anytime you're in front of your client is an opportunity to ask for referrals. So why policy management is needed, and really needed more today than ever before. A lot of it has been due to product innovation. So innovation, certainly not a bad thing at all. Life insurance has certainly evolved with new product, new innovation, new bells and whistles that come along with products. That leads to more complication and more complicated products. Certainly, again, not a bad thing. A lot of the innovation is certainly for the benefit of the client, but it leads to more complicated products. They need a trusted advisor to explain all of these intricacies of the life insurance policy to them and what's going on. It's going to give you an opportunity to monitor performance. So with life insurance policies today, as we're going to see here in a minute, policy performance is falling more on the shoulders of the policy owner and less on the shoulders of the actual company issuing that policy. So at least reviewing the policy on an annual basis gives you an opportunity to monitor the policy performance. And that comes along with monitoring the policy funding, making sure that policy is still adequately funded and it's going to be there for the intention that it was put in place for. so often today, we see insurance is no longer just insurance. We're no longer selling just a death benefit. Oftentimes, we're selling the living benefits of insurance. Insurance is part of a strategy now. It's not just protecting loved ones in the event of an untimely death. There's a strategy involved with insurance, be it funding a partially tax-free retirement with life insurance and overfunding a policy. With the intention of taking a stream of income from the policy down the road when we hit in retirement. Part of a executive bonus plan, perhaps, or a buy-sell arrangement, making sure that policy is going to be there when it's needed the most. And then, of course, keeping an eye on carrier stability, reviewing carrier ratings, and the financial strength of the carrier is a very important aspect of policy management as well, making sure that carrier is still solid and able to pay claims when needed. So the evolution of life insurance in this slide, it is certainly not meant to be a chronological representation of how life insurance has evolved over the years, but more so just an illustration of how risk of the policy has been transferred over the years with the evolution of life insurance and the more innovation that's come along. It's been the risk of that policy and managing that policy has fallen less on the shoulders of the insurance company and more so on the shoulders of the policy owner. So starting with whole life, of course, the most basic form of insurance out there. It's strong guarantees out there, certainly a bit more expensive because of those guarantees, but as long as the client is making the premium payments on time and in full in some manner, that death benefit is always going to be there. Making sure that that policy is still going to be in force falls on the shoulders of the insurance company. The policy owner just has a responsibility of making those premium payments. With the introduction of universal life and the different spin-offs of universal life, more of that risk was transferred from the insurance company's shoulders to the policy owners. So universal life presented the opportunity to earn an interest rate rather than dividends, just a different type of interest with universal life. The insurance company has a fixed crediting rate that they declare annually, that the policy is designed to keep cash value in the contract, and that cash value accumulation is going to be based on the fixed crediting rate that insurance company has declared. Bring into the picture IULs, Index Universal Life, and Variable Universal Life. Pardon me. And more of the policy performance has now fallen on the policy owner. So the insurance company with Universal Life would control the crediting rates. Now the policy owner has more flexibility in how that cash value is going to accumulate and how interest is credited to the policy. They can choose the different allocation options, different index options for the Index Universal Life products. And Variable Universal Life, they can be as aggressive as they want or as conservative as they want in the selection of the underlying sub-accounts with those mutual fund sub-accounts in Variable Universal Life. So it's no longer the insurance company declaring the interest rate. All of that is basically at the direction of the policy owner and their elections that they make either at the time of sale or on their reallocation options. So more of that risk of keeping the policy in force has fallen more on the shoulders of the policy owner. It's no longer just making the premium payment and that policy is going to be there. It's much more than that now. It's making the premium payment, making sure that we're earning interest and keeping that cash value in the policy, so it's going to be there when we need it. So when we dig into the policy review, there are really 4 key review categories to pay attention to and take a look at. The first one is going to be the policy funding, and really points 1 and 2 here kind of go hand in hand. So policy funding and policy performance. Starting with policy funding, we're looking here at the amount of premium payments and how those premiums are being paid. So are we underfunding the policy, or are we overfunding it? Are we just right? How are those premiums being paid? Are they being paid out of pocket, or perhaps it's a whole life policy and we're using loans to pay the premiums or dividends? So how that policy is actually being funded, how those premiums are being paid. Policy performance, we're taking a look at the cash value accumulation, seeing how that policy is actually performing, how the cash value is performing, and then taking a look at the underlying charges and fees associated with that contract. If there are any policy loans outstanding on the policy, if left unmonitored and unmanaged, policy loans can become an absolute nightmare for your clients. So a lot of times we are looking at, I'll take it back to the partially tax-free retirement with life insurance and overfunding an IUL and then taking loans out during retirement. Certainly a viable strategy there, but that only means there's more management that's necessary once we start taking those loans and making sure that the policy is still performing, that loan value is not growing too big and going to threaten a policy lapse earlier than intended, if it's intended at all. That could possibly present a taxable situation and really just get in a lot of hot water there with some unintended consequences if left unmanaged. So taking a look at policy loans, if they're present, how are they impacting the policy? Do they need to be addressed? Do we need to start paying those back? So on and so forth. Then, of course, taking a look at carrier stability, again, doing a review of the strength and stability of the carrier, checking ratings and financial stability. So really the first step in completing a policy review is to gather data. Can't review something that we don't know anything about. So gathering data about the in-force policy is going to be the first step. And really I'm just kind of honing in, trying to keep it as high level as possible to not get too deep in the weeds here, but just honing in on universal life and whole life. For both of those policy types, the two most important pieces of information I have, I guess the minimum, if you will, is going to be either the most recent annual statement or the current policy data page that the carrier can provide. Outside of that, a current in-force illustration. So seeing how the policy stands today based on the current funding at the current interest rates and current scales, current charge scales. So just a plain vanilla in-force illustration. If the client's paying premiums, we want to see how that policy is performing based on those premiums continuing all the way throughout at either the current crediting rate on a fixed UL, current dividend rate on a whole life policy, or current illustrated rate based on their allocations on an IUL. And then taking a look at the current charge scales, current COI charge scales. Those two pieces at a minimum are what's needed to get a start on the annual review. From there, I would also recommend looking at some alternate funding scenarios. And this is going to allow you to have some conversations with your clients a bit easier, show some different scenarios and show some different options. So with both, we could look at a suspended pay or suspended outlay situation where we cut off funding today. Perhaps it's a universal life policy and we wanted to suspend funding and no longer pay premiums out of pocket into that policy. So we show a zero outlay scenario, zero pay scenario in the current situation, or I'm sorry, the current illustration. See how that's going to impact the policy if we cut off premiums. Will the policy stay enforced to maturity, or is it more likely going to show a premature policy lapse? Also on the universal life side, we could take a look at a minimum to mature illustration. So what's the bare minimum we can pay in that policy to keep that coverage in force to the policy's maturity age, be it 100 or 121, whatever the case may be. So those three items, the in-force illustration, ran at the current premium, current funding level, coupled with a suspended pay situation, and then a minimum to mature illustration. I'm going to give you a range of options to present your client at that annual review meeting and say, Mr. and Mrs. Client, here is how your policy is performing today based on the premiums that you've been paying in since it was taken out. Show them the range. If you were no longer willing or able to pay those premiums on an ongoing basis, here's what will likely play out if you cut those premiums off. And then on the other side of that, if you were willing and able to continue paying premiums, perhaps increase premium payments, here's what would be needed to keep that policy in force to maturity. Similar situation on the whole life side. With whole life, of course, premiums have to be paid one way or the other. They're either being paid out of your client's pocket, out of the policy owner's pocket, or they're being paid by perhaps the use of dividends if it's a participating policy, or they're being paid by premium loans. Those premiums are being paid one way or the other. It's not like universal life where you have the flexibility to adjust premium payments. Whole life policies, those premiums have to be paid one way or the other. So we can still show a suspended outlay situation and change the premium payments to being paid by dividends and or by premium loans. We could also look at an alternate use of dividends. So perhaps maybe dividends are being paid out to the policy owner in cash. Well, what's going to happen if we change those dividends to purchasing paid up additions? How's that going to impact the policy? Are we going to get some added death benefit? More than likely, yes. So looking at some different scenarios with whole life, even though we're not quite as flexible as universal life, we do have some options on whole life as well. So taking a look at universal life and actually doing a review of the information that was gathered from the insurance company for a universal life policy. And this is kind of all-encompassing fixed UL, no lapse guarantee UL, IUL, VUL. All of those are kind of lumped into this universal life category. So really splitting the review out into two segments here. We want to look at a funding review and then a performance review. So starting with funding, reviewing that current illustration at the current premium level and current crediting rates and current charges. Is the policy underfunded? Is that illustration showing the policy lapsing prior to maturity or lapsing prior to perhaps age 105? Maybe we didn't structure it to age 100, or I'm sorry, to age 121. We just structured it to carry past age 100 to age 105. Is it showing a premature policy lapse and unintended lapse? That would be an underfunded policy. Is the policy adequately funded? Is it maintaining with how it was originally illustrated and death benefits still shown to stay in force to maturity as an adequately funded policy? Or is it overfunded? Perhaps we're paying entirely too much in premiums into this policy for what it's intended. Now, of course, there's some caveats here. If we are intentionally overfunding a policy in the early years to accumulate cash and take loans out at retirement, of course, that's going to be more along the lines of adequately funded. Where we can get into some overfunding situations is perhaps a no lapse guaranteed policy, where we're just paying for that death benefit protection. We're really not concerned about the cash value performance. Are we paying too much for that death benefit protection? Are there better options, more competitive options out there? Could we reduce that funding? So we have the current illustration with the current premium amounts, and then we compare that to the minimum to mature illustration we received from the carrier. Is that minimum to mature premium less than what we're currently paying? If so, we're in an overfunded situation. We could, save our clients some money and back those premiums down and find a better use for, that excess in funding. Along with funding, performance, again, is going to kind of come hand in hand here. So the two really work together. So performance of the policy and a review of the policy's performance and cash value performance, we really want to look at the crediting rates. Fixed UL, what are the current crediting rates? How have they changed over the years? Are we still as originally projected, or did the carrier have to decrease those or increase them on the flip side? Same with the cap rates and participation rates for your IULs. Are those cap rates adjusting down, or are they staying the same as originally projected? Cost of insurance. This is a big one, can sometimes be kind of silent out there. And a silent killer if they're not substantial changes in cost of insurance. Pardon me. There have been cases within the past few years here where big name carriers had to announce massive cost of insurance increases on blocks of policies because of the perpetually low, it seems like, interest rate environment and other policies not performing as expected, their investment performance, whatever the case may be. These companies had to come out and increase cost of insurance charges. Well, that can have a huge impact, of course, on the cash value. And what once was an adequately funded policy, going back up to funding, the premiums that were originally projected have been paid from policy inception to current date, and the carrier that original funding level was projected to keep the policy in force, and the carrier all of a sudden comes along and increases their cost of insurance scales. Now perhaps we could be looking at an unintended lapse, and that policy that was going to mature is now showing an early lapse. So keeping an eye on cost of insurance charges and how that's impacting cash value is certainly pertinent in the performance review. And again, coming back to policy loans, if there are loans outstanding on the policy, how are they impacting the policy? Are we close to loaning out the entire cash value, which would mean a policy lapse, which could certainly potentially trigger a taxable event for the policy owner? So managing those policy loans, making sure they're not growing too large, and cash value performance is still on track to support those loans. Just doing a review of those loans and making sure they're not growing too large and eventually going to become a problem for the policy is important in performance as well. Similar aspects we're going to take a look at with whole life as well. So again, while whole life premiums have to be paid one way or the other, we can have an underfunded whole life policy. Certainly is possible. Typically, these situations arise when we have term riders or loans outstanding on the policy. So if term riders are there and it's no longer a level term rider, it's now an annual renewable term. As the client ages, the premiums needed to support that term portion of the death benefit increase. So to maintain that full level of death benefit, a lot of times there could be an increased and out-of-pocket outlay needed from the policy owner to support that full level of death benefit. Is it adequately funded? Of course, no outlay changes projected. Premiums are projected to stay level and stay the same throughout maturity. It would be more of an adequately funded policy. Taking a look at the performance of the whole life, here, where universal life, we were concerned about the crediting rates and participation rates, cap rates, whatever type of universal life policy it was. With whole life, the method of crediting interest is primarily going to be dividends if it's a participating whole life policy. So taking a look at dividend history, the dividend projections on the current dividend scales, and how those dividends are being used. So you have a number of different options with whole life to use those dividends, be it purchasing paid up additions, paid up additional insurance, letting the dividends accumulate at a specified interest rate or having them paid out in cash, or even applying dividends to premium to reduce the premium. How are they being used? Is there a more efficient use of those dividends that are being credited? Taking a look at the term riders. So again, reviewing if the term rider is nearing an expiration date, if it's going to an annual renewable term, is the cost of that term rider going to increase? And then again, loans, more prevalent on whole life policies, as a lot of the whole life policies have a non-forfeiture option of automatic premium loan. If the client doesn't send in their check for their annual premium or monthly premium, 1 year, that premium still has to be paid one way or the other, and an automatic non-forfeiture option for a lot of whole life policies is that automatic premium loan, where it goes ahead and takes out a loan against the cash value to pay that premium. So taking a look at the loans, if they are present on the policy, how are they impacting that policy? And then term, just hitting briefly on term, you may not see it relevant to do annual reviews and policy reviews with your term clients, but it certainly is a great opportunity just to make sure that term is still competitive. So going out to our website perhaps, or giving us a call and asking us for a term quote for a term client you may have, just to make sure that there's nothing more competitive out there. Perhaps it could make sense to move to a different term product if the client's still insurable. Take a look at the level premium guarantee. Perhaps it's a 10-year term and we're nearing the 8th policy year, 9th policy year, nearing the end of that level premium guarantee. Now it's time to start doing some needs analysis and see if that level of coverage is still needed. If so, we need to start looking at some other options to make sure there's not going to be a lapse in coverage when that level premium period on that term expires, because of course after that level premium guarantee period, those premiums are more than likely going to shoot through the roof to keep that coverage in force. And also looking at the conversion privileges. So if there is still a need for that insurance coverage, we don't want to go into a new term product. Perhaps the client's no longer insurable. They've had a change in health since you last sold that term policy. Well, is the policy convertible? To expand on that, is it still convertible without proving insurability? So it could be a great way to keep coverage in force on a now uninsurable client without proving insurability, to be able to convert that policy to a permanent plan of insurance at the originally issued underwriting class. If it is convertible, keep an eye on when that conversion privilege expires. So not all policies are going to be convertible to the end of the level premium guarantee period. Maybe they're only convertible for 5 years and then that privilege expires. So making sure you're keeping your client informed of that conversion privilege and when it expires, to make sure you're not missing an opportunity to keep that coverage in force and convert down the road without going back through exams and labs. So after we've done the review, we've gathered the data, gathered the illustrations, taken a look at the illustrations, and reviewed them with before meeting the client, we want to take a look and identify our findings. So based on that information that's received, there are a number of different findings, of course, that can come out here. We could see that the policy is looking to be underfunded. We have an untimely lapse prior to maturity. We have a troubled policy that is going to call for some type of remediation to fix that problem. Perhaps the policy is overfunded. Maybe there's a more efficient use of those premium payments, or a more efficient use of the excess premium payments, depending on the situation and how it's overfunded. If the policy underperforms other competitive plans. So here, taking it a step further, we get the in-force illustrations from the carrier and that in-force policy data. We take that same information and try and build an apples-to-apples comparison with a similar type of product from a different company, just making sure that that product is still competitive with what's out there today. Make sure there's not another product that is going to address the client's needs in a more competitive, more efficient manner. So that is certainly a way where you can take that policy review to the next level and show them a comparison of some other options, other similar options out there, and saying, Mr. and Mrs. Client, your policy is still very competitive with what's available for sale today, or Mr. and Mrs. Client, there's some other options out here. Let's talk about your health and if it may make sense to explore one of these other options. Taking a look at COIs, as we had mentioned, an increase in COI charges, if they can be considered excessive compared to competitors, going back to that comparative analysis, if you will, reviewing those COIs and how they're impacting the policy's cash value performance. If any of those items are discovered in your policy review and you identify a troubled policy, then the next step is to start discussing some remediation options with your client. And depending on the policy, there are a number of different remediation options to consider. The generally available options out there, and these really kind of hone in more on the universal life side. Some of these can apply with whole life, but primarily these are going to be universal life remediation options. We can, one, increase funding. So if the policy is underfunded, it's projected to lapse prior to maturity, we can take a look at increasing funding if the client is willing and or able to increase that premium outlay. We could look at decreasing the face amount, of course, within tax compliant constraints there, but look at decreasing the face amount. Perhaps that level of coverage isn't needed, and we can decrease that face amount to a more appropriate level. That is going to bring down the premium, the funding commitment that the client would need to make. We could look at a combination of the first two, so increasing funding and decreasing the face amount to get to a more appropriate level, both face amount and funding wise. could look at a 1035 exchange. So perhaps that policy is no longer competitive with what's available out there. There's other options available. The client's still insurable. We could explore a 1035 exchange with that cash value and replace that policy with a more suitable option, or could consider a cash surrender. So perhaps that policy is underperforming. It's not adequately funded. It's going to lapse soon. Don't need that coverage anymore. That level of death benefit is not needed. I could explore a cash surrender instead of a 1035 exchange and pull that cash value out. Of course, with any remediation option and any change to coverage, need to be prudent and investigate the suitability of it, do a needs analysis, make sure the client is still insurable before exploring one of these options as well. So a couple of case studies put together, again, trying to keep it fairly basic and high level for you to not get too deep in the weeds here. But, one case study here, you can see in the upper left-hand scenario, we have a 67-year-old male. He's in a fixed universal life, so a fixed crediting rate universal life product. Face amount of $1.2 million, and is paying $23,000 a year for that coverage. We went out and requested current funding illustrations from the carrier and the latest annual statement, did our review. We see that the crediting rate has been decreased since issue. So, this could have been a policy that was issued in the 90s at higher crediting rates, higher interest rate environment, and since then, that crediting rate has been pulled way back, and it's actually down to its minimum guaranteed crediting rate, which means those premiums that were originally illustrated are no longer sufficient to support that coverage. We don't have that cash value growing like it was originally illustrated. So need an increase in funding to keep that policy in force and support that policy. Cash value is decreasing because we haven't been earning that original crediting rate. COIs are eating into that cash value more than originally projected because of that decrease in crediting rates, and that's all resulting in an untimely lapse, a premature lapse prior to maturity without increasing the funding in that policy. So a solution, agent completes a needs analysis, goes over the available options with the client. Client no longer needed that full $1.2 million in death benefit, didn't want to increase the funding, was not interested in increasing the funding to keep that policy in force. So a viable option here is to do a 1035 exchange into a single premium life product. We're not going to get that same level of coverage, but we already identified that the client did not need that full $1.2 million. We're salvaging the cash value that's left in that policy that's underperforming and nearing a policy lapse, and putting that into a single premium life product. That's going to be a paid up life policy, paid up death benefit. It's guaranteed all the way throughout. They're never going to get another premium notice to pay additional premiums to keep that policy in force. And it's a more appropriate level of coverage, again, as that $1.2 million death benefit was no longer needed. Second case study, kind of a similar situation here. So in this case, we have a 52-year-old female, again, in a fixed crediting rate universal life policy, $500,000 face amount. She's currently paying $8,500 in annual premiums for that policy. So again, just like the other policy, found that crediting rate has been decreased since issue. It also looks like a COI increase took place. That cash value is decreasing rapidly than the year before, more rapidly rather. So all of that's going to result in, again, increasing the funding, increasing the out-of-pocket premiums to pay into that policy to keep that $500,000 coverage in force and avoid that policy lapse. So in this case, the client is still working, still has that insurance need, wants to maintain that $500,000 death benefit level to leave behind her beneficiaries. She's willing and able to pay premiums continually and even increase funding if need be. Of course, that's not ideal, but if need be, she's willing and able to pay premiums. So in this case, again, we can explore 1035 exchange here. With this particular policy, we're going to take a look at a no lapse guarantee. So we identified that $500,000 death benefit is still needed. She still wants to maintain that coverage, wants it to be there no matter what. So instead of looking at another non-guaranteed policy where we could still find ourselves in the same situation, 5-10 years down the road, let's look at 1035 exchanging that cash value into a no lapse guarantee policy, where that policy is going to be guaranteed no matter what. As long as premiums are paid on time and in full as scheduled, a no lapse guaranteed death benefit is always going to be there. Not designed for cash value, more concerned about the death benefit. So this is going to be a product that's going to much more align with the client's goals in maintaining that insurance level of $500,000 and keep that policy in force and not have to worry about the ongoing management of the policy performance. We just wanted to take a look at premiums from there. So just a couple of case studies, a couple of scenarios to run by you, get your minds thinking about clients that you may have in your books of business that could be in a similar situation. So again, we are big on policy reviews. There's a number of reasons to consider annual reviews and conduct the policy reviews with your clients. These life insurance policies are not getting simpler, they're getting more complicated. And I don't care what the type of policy is, from a whole life to a basic term, touching your clients on an annual basis and staying in front of them on an annual basis and reviewing their policies with them is certainly phenomenal customer service. Great way to show you are still your client's trusted advisor, and if there are any issues with those policies, you're going to be the one to handle and remediate those issues and possibly uncover those new sale opportunities, either from remediating those policies or updating your fact finder and finding a change in insurance needs. So with that, do appreciate everyone's time. We are coming up on our time here, so want to be respectful of that. But do appreciate everyone taking some time out of your Monday morning to join us. Hopefully you found this useful and beneficial and could get your wheels spinning about ways you can incorporate annual reviews and annual policy reviews with your clients to not only provide great customer service, but also help you generate an increase in business and sales. So with that, I will be following up with everybody here shortly, see if there are any questions may have come up after the fact, and see if I get some additional information out. Thank you again for your time. Hope you all have a great rest of your Monday, great week, and we'll be in touch soon. Take care.